By the time retail investors realize that they have become exit liquidity, the transfer of wealth has already been executed. The insider wallets have distributed their holdings, and the chart is collapsing under the weight of manufactured supply. The prevailing assumption in crypto markets is that price appreciation signals genuine demand, and that publicly available information creates a level playing field between early participants and latecomers. But when you examine the actual mechanics of how tokens are distributed, how narratives are engineered, and how influencer campaigns are financially structured, well, a far more calculated reality emerges. The on-chain evidence is public, the patterns repeat every single cycle, and the tools to detect them before you commit capital are entirely free. And so in this video, we're going to be going through the complete framework that you need before you buy anything in this market again. My name is Lewis, and you're watching The Coin Bureau. Now, the single most dangerous instinct in crypto investing is interpreting vertical price action as confirmation that you should enter a position. When a token surges 500% or more in a matter of weeks, the overwhelming psychological response is to assume that massive demand is driving the move and that there is still room to run. But, of course, this instinct is precisely what manufactured pumps are designed to exploit. You see, a healthy rally is characterized by increasing spot buying volume that builds gradually alongside rising open interest in derivatives markets, with consistent order book depth on both sides of the trade. The price moves upward in a staircase pattern, consolidating at each level before advancing, because real organic demand requires time to accumulate. A manufactured pump looks fundamentally different. The volume composition during a parabolic move frequently reveals that the majority of buying pressure is coming from leveraged long positions rather than spot market accumulation. This means that traders are borrowing capital to chase the move, creating an increasingly fragile structure where a relative minor price reversal triggers cascading liquidations. Furthermore, the order book depth on these parabolic charts is typically razor thin on the bid side, meaning there are almost no resting buy orders beneath the current price to absorb selling pressure. Put simply, the chart appears to be surging because there is nobody standing in the way of aggressive market orders, pushing the price upward through an empty order book. And when you combine thin bids with a heavily leveraged long bias, well, the conditions for a violent reversal become mathematically inevitable. The moment a large holder begins distributing tokens into that thin liquidity, the price collapses through multiple levels instantaneously, liquidating the leveraged positions that were providing the artificial buying pressure in the first place. This creates the classic exit liquidity scenario where retail participants who entered during the parabolic phase absorb the entirety of the sell pressure from insiders who accumulated at a fraction of the current price. Now, you might assume that if the underlying project has a compelling narrative, the price recovery will eventually reward patient holders. That assumption completely ignores one of the strongest exit liquidity signals in the entire crypto ecosystem, which is the deliberate rotation of project narratives to capture whatever retail capital is currently chasing at the moment. When a token that positioned itself as decentralized finance infrastructure 6 months ago suddenly rebrands as an artificial intelligence platform, that is not innovation unfolding in real time. That is a calculated marketing pivot designed to tap into the dominant speculative narrative of the current cycle. The most comprehensively documented case of this exact phenomenon is actually Virtual's protocol. This project launched in 2021 as PathDAO, a GameFi and metaverse gaming guild that raised $16 million in seed funding before its token collapsed approximately 99% during the 2022 bear market, shrinking to a market capitalization of under $6 million. In December 2023, the team executed a complete rebrand to Virtual's protocol, repositioning the identical project as consumer-grade AI infrastructure for autonomous agents. The Virtual token subsequently launched on Base Layer 2 at roughly 0.03 and surged to an all-time high of $5.07 on January 2nd, 2025. That represents a gain exceeding 16,000%. By April of this year, the token had corrected approximately 87% from that peak. The underlying technology did not fundamentally change between the failed gaming guild and the $5 AI token. The narrative changed, and that narrative change perfectly synchronized with the ChatGPT era hype cycle, generating billions of dollars in retail inflows at the absolute top. This pattern is visible across the current market data even right now. FET, which merged into the Artificial Superintelligence Alliance, explicitly branded as Unified AI Infrastructure, surged 31.6% over the past 30 days, while UNI, the flagship DeFi governance token, collapsed 19.4% over the exact same period. That 50 percentage point spread between two sectors tells you precisely where retail capital is rotating and which narratives are being used to attract fresh buyers. The reality is that FET hit its all-time high of approximately $3.47 back in March of 2024 and is currently trading near 23 cents, representing a decline of nearly 90% from its peak. The AI narrative attracted capital at the top, and the holders who entered during that narrative wave became exit liquidity for early participants. But the narrative pivot alone cannot generate sufficient buying pressure to execute a distribution at scale. That requires a coordinated amplification infrastructure, and this brings us to the influencer Shilling playbook that has been industrialized across the crypto industry. In September of 2025, blockchain investigator Zach XBT leaked a spreadsheet detailing a coordinated promotional campaign involving over 200 crypto influencers. The document contained online aliases, Solana wallet addresses, and specific pricing rates for promotional posts. Of the 160 influencers who accepted the arrangement, fewer than 5 properly disclosed their posts as paid advertisements. That represents a non-disclosure rate exceeding 97%. Payments ranged from low 3-figure sums to 5-figure amounts, with one account receiving $60,000 for a marketing campaign without any public acknowledgement that it was a sponsored promotion. The leaked data revealed coordinated posting timelines designed to create the appearance of simultaneous organic market interest, preset posting windows across multiple platforms, and bundle pricing discounts for influencers willing to amplify across channels at the same time. And this is not anecdotal speculation about occasional bad actors. This is documented industrial infrastructure for retail capital extraction. Furthermore, the compensation structure has evolved specifically to avoid disclosure requirements. The old model involved direct cash payments for explicit posts, which created obvious regulatory exposure. The current model uses what the industry calls KOL rounds, where influencers receive early access to tokens at heavily discounted valuations, with favorable vesting schedules that allow them to sell well before retail participants. Because this arrangement is structured as an investment rather than a direct payment, the disclosure obligations become far easier to obscure. The influencer is technically a holder, but they acquired their position at a fraction of the price that retail will pay. This means that every bullish post from that influencer is fundamentally a defense of their own financial position, not an independent analytical assessment. And the scale of these operations is honestly staggering. In the first half of 2024 alone, the Polkadot Treasury spent approximately $87 million, with $37 million allocated specifically to marketing and outreach, and roughly $5 million directed to approximately 17 KOL partnerships at an average rate of $28,000 per influencer per month. A community audit of that expenditure found that several of the funded accounts had high concentrations of bot followers and minimal engagement from legitimate audiences. The detection framework here is pretty straightforward. When you see multiple accounts posting identical talking points about the same token within a compressed time frame, when creators who have never covered a project suddenly express enthusiastic interest, when the comment sections show high view counts paired with repetitive low-quality engagement, you are almost certainly looking at a coordinated distribution campaign. Now, recognizing manufactured narratives and paid amplification gives you a qualitative filter. But the most powerful confirmation layer is entirely quantitative and sits on-chain, available to anyone willing to look at it. Arkham Intelligence currently tracks over 800,000 distinct real-world entities across more than 800 million individual wallet addresses spanning 12 blockchains. The platform's entity-based labeling system links pseudo-anonymous wallets to exchanges, venture capital firms, known traders, and government institutions. The critical workflow is pretty straightforward. First, identify the vesting contract addresses from the project's documentation or GitHub repository. Label these addresses with the tracking system and set alerts for any outflows exceeding a meaningful threshold. When tokens route from a vesting contract to an intermediate address and then aggregate into a centralized exchange deposit wallet, well, you are watching insider distribution unfold in real time. The Visualizer tool maps these fund flows across chains and wallets, specifically exposing the hop patterns that insiders use to obscure the trail between their allocation and the exchange where they intend to sell. Nansen provides a complementary intelligence layer by classifying over 500 million wallets into behavioral categories. Their smart money labels identify wallets with proven track records of realized profits, while fund labels tag institutional-grade entities. When the token God mode display shows smart money wallets engaged in sustained net selling, particularly through repeated exchange inflows over days or weeks rather than a single transaction, you are observing a controlled distribution phase. A single inflow is noise, but systematic inflows from labeled sophisticated actors represent a high-conviction bearish signal regardless of what the price chart is doing. Token unlock schedules are arguably the most predictable exit liquidity catalysts in the entire market. Approximately 90% of significant unlock events correlate with downward price pressure, and that pressure frequently begins not on the unlock date itself, but roughly 30 days before, as participants with access to the schedule begin positioning accordingly. The critical metric is the unlock to volume ratio. When the dollar value of tokens scheduled for release exceeds 2.4 times the average daily trading volume, there's simply insufficient market liquidity to absorb the incoming supply without significant price concessions. March this year saw over $12 billion worth of tokens scheduled to enter circulation in a single month, roughly 3 times the average monthly average. For context, when the team and early investor allocations unlock, the sell pressure risk is structurally elevated because these recipients hold tokens at near zero cost basis. Community treasury unlocks carry lower immediate risk because governance mechanisms, they typically delay deployment. The distinction between who receives the unlocked tokens matters as much as the volume of tokens being released, and the final on-chain confirmation comes from DeFi Llama's TVL verification. A protocol displaying high total value locked alongside negligible fee revenue is almost certainly running on incentivized or recursive deposits rather than a genuine economic activity. The double count toggle strips out receipt tokens and LP tokens that have been redeposited elsewhere, revealing whether the headline TVL figure is counting the same capital multiple times. When the gap between the toggled figure and the advertised number is substantial, you are looking at manufactured scale. Now, the purpose of every signal covered in this video is to give you a single consolidated framework that you can apply before committing capital to any position. The checklist contains 6 primary indicators. First, parabolic price action accompanied by declining spot volume and thin order book depth on the bid side. Second, a narrative pivot within the preceding 30 days that aligns with whatever retail is currently chasing, without any corresponding technical or product milestone. Third, a coordinated influencer surge from creators with no prior coverage of the project, featuring identical talking points and absent disclosure labels. Fourth, a major token unlock scheduled within the next 90 days that exceeds 5% of the current circulating supply, particularly when the recipients are team members or early investors. Fifth, insider-labeled wallets routing tokens through intermediate addresses towards centralized exchange deposit addresses. And sixth, weak on-chain fundamentals relative to market capitalization, specifically low fee revenue against inflated TVL, declining daily active addresses, and a market cap to TVL ratio exceeding 5. If 3 or more of these conditions are present simultaneously, the statistical probability that you are providing exit liquidity to better informed participants becomes extremely high. Each individual signal carries noise, but convergence across multiple independent data streams dramatically reduces the likelihood of a false positive. The current market environment makes this framework more urgent than ever. Every single altcoin tracked in our basket is trading below its 200-day moving average. ARB sits 44.7% below its 200-day average. Wild WLD is nearly 47% below. And even Bitcoin, the strongest relative performer, remains 15% underwater on that metric. The 30-day relief rallies in tokens like Pepe and ARB, up 10.9% and 9.5% respectively, are occurring inside catastrophic 3-month downtrends and drawdowns of 40% to 49%. These bounces are not trend reversals. They are precisely the type of price action that attracts fresh retail capital into positions that insiders have been distributing throughout the broader decline. Crypto markets will always operate with information asymmetry because insiders will permanently hold advantages in timing, allocation, and intent. But the distance between what they know and what you can independently verify is shrinking with every tool, improvement, and every on-chain data source that becomes publicly accessible. The vesting contracts are readable, the wallet movements are traceable, the influencer payments are increasingly documented, and the narrative rotation playbook repeats with remarkable consistency across every market cycle. The objective is not to achieve perfect information parity with insiders because, well, that is structurally impossible. The objective is to build the discipline of running this checklist before every allocation so that when the next parabolic chart floods your feed with urgent calls to buy, you are executing a decision based on verifiable data rather than becoming the counterparty to someone else's exit. So the question is, will retail investors finally adopt the on-chain verification tools that make this extraction visible before it occurs? Or will the next cycle simply repeat the identical pattern where manufactured narratives and coordinated campaigns harvest billions from participants who never checked the data that was sitting right in front of them? My guess is the latter, but I want to know your perspective in the comments below. And if you want to understand how token unlock schedules and vesting mechanics are reshaping the broader altcoin market throughout the rest of the year, well, you could check out our video dedicated to that analysis right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.